Hello there. Today we will learn how to mind map IFRS 16. Leases. IFRS 16 gives guidance on the accounting treatment for lease by lessee, lease by lessor, and sale and leaseback transactions. Further, for accounting for lease by lessee, there are guidance for recognition and measurement of lease at commencement date, and recognition and measurement exemption to lessee. For accounting for lease by lessor, there are accounting treatment for finance lease and operating lease, along with the accounting treatment for manufacturer dealer lessor leases. Accounting of sale and leaseback depends on whether transfer is a sale or is not a sale. Accounting for lease by lessee. The previous version IS 17, Leases, was criticized because it did not require lessees to recognize assets and liabilities arising from operating lease. IFRS 16 introduces a single lessee accounting model and requires a lessee to recognize assets, right of use, and liabilities for all leases with a term of more than 12 months, unless the underlying asset is of low value. Recognition and measurement at commencement date. At commencement date the lessee shall record right of use, asset, and liability. Right of use. At commencement date, a lessee should measure the right of use, asset, at cost. Cost comprises present value of lease payments, any lease payment made at all before the commencement date, less any lease incentives received, any initial direct cost incurred by lessee, any disposal, dismantling costs incurred by lessee. Subsequent measurement. Account for any depreciation expense and accumulated impairment losses. Liability. At commencement date, a lessee should measure the lease liability at the present value of the lease payments that are not paid at that date. Subsequent measurement. The lease liability is measured at amortized cost using the effective interest method. Each lease payment consists of two elements: finance charge on the liability to the lessor, and partial repayment of liability. Total liability must be divided between current liability and non-current liability. Recognition and measurement exemption to lessee. A lessee may elect not to apply the recognition and measurement of right of use asset and liability to short-term lease, 12 months or less, and assets of low value. Examples include office furniture, laptops, tables, telephones. Expense these out on straight-line basis or any other method. Accounting for lease by lessor. Accounting for lease by lessor depends on whether the lease is a finance lease or operating lease. Finance lease. In finance lease the lessor does not record the leased asset in its financial statements, as it has transferred the risks and reward. Instead, he records the amount as receivable. Receivable is described as net investment, which is the sum of fair value and initial direct cost. For subsequent measurement, record payments received during the year. Record finance income. For operating lease, the lessor records the leased asset in its financial statement, as he has not transferred the risk and reward of ownership. At commencement the lessor adds initial direct costs incurred by lessor. For subsequent measurement, lessor records the depreciation expense. The policy must be consistent with lessor's policy. Account for any impairment loss. Records rental income on a straight-line basis over lease term. Accounting for manufacturer dealer lessor. A manufacturer or dealer often offers to customers the choice of either buying or leasing an asset. As these are lessors, therefore lessor's accounting treatment are applied. Lease for manufacturer dealer lessor results in finance lease or operating lease. Finance lease. A finance lease gives rise to two types of income: profit or loss, which is the difference between sales and cost, and finance income. For operating lease, does not record sales, record asset, record depreciation, record impairment, record rental income. Sale and lease back, where transfer is a sale. For seller lessee, or for buyer lessor. For seller lessee, if the transfer of an asset by seller lessee satisfies the requirement of IFRS 15, then the lessee shall, if sale at fair value, to recognize the carrying value of the asset, recognize the actual gain, loss. Sale above fair value. If the sales proceeds are above fair value, the difference between sales proceeds and fair value shall be treated as additional financing provided by the buyer lessor. The additional financing shall be deducted from the present value of lease payments when calculating right of use and gain, loss. Sale below fair value. If the sales proceeds are below fair value, the difference between sales proceeds and fair value shall be treated as prepayments of lease payments. The prepayments shall be added to the present value of lease payments when calculating right of use and gain, loss. For buyer lessor, if the transfer of an asset by seller lessee satisfies the requirements of IFRS 15, then the lessor shall account for purchase of asset according to IAS 16. Treat it as operating lease according to IFRS 16. Account for any initial direct investment. Sale and lease back, where transfer is not a sale. For seller lessee, or for buyer lessor. For seller lessee, if the transfer of an asset by seller lessee does not satisfy the requirements of IFRS 15, then the lessee shall continue to recognize the transferred asset. Shall recognize a financial liability equal to the transferred proceed, in accordance with IFRS 9. Lease amortization schedule will be needed for principal and interest charge over the lease term. For buyer lessor, if the transfer of an asset by seller lessee does not satisfy the requirements of IFRS 15, then the lessor shall not recognize the transfer of asset. Recognize a financial asset equal to the transferred proceed in accordance with IFRS 9. Lease amortization schedule will be needed for principal and interest income over the lease term. Thanks for watching. More stuff coming soon.